In today's episode, I speak with Dave DeCruz, a director in TD's asset-based lending ABL group based out of Toronto, Canada. I have known Dave for several years and have always been impressed by his passion for his business. And as you will hear, our episode goes into several different areas as we cover the niche business of ABL and where it fits in the commercial banking landscape relative to other lending solutions available within the bank. We also talk about his start in corporate banking and how that differs to ABL, his experience working for a US bank in the Canadian marketplace, and his advice on building a professional network to source deal flow in the ABL marketplace. When I was a middle market commercial banker, I didn't have a good understanding of where I could leverage my bank's ABL team to provide better value for my clients, and I mistakenly saw them as competition to my deal flow. As Dave puts it, ABL focuses less on historical cash flows, which traditional lenders prioritize, and more on unlocking liquidity on the balance sheet as an alternative to a traditional operating line. Oftentimes, balance sheet heavy companies that have thinner historical profit margins or have higher cash flow volatility are better suited for ABL. As Dave suggests, the best way to collaborate with your internal ABL team is to leverage their specialized knowledge and use them as an alternative financing source for your clients that may have tripped the covenant or do not meet debt servicing hurdles of a traditional term loan. In that way, the client can stay with your bank and you can provide superior value to your clients, making you a better banker, which this podcast is all about. So without further ado, here's my conversation with Dave DeCruz, Director of Asset-Based Lending at TD Commercial Bank. Welcome to the Inside Commercial Banking Podcast. This podcast is for commercial bankers that are in the business of lending money. My mission is to empower the commercial banking community by sharing best practices and the secrets to success through interviews with rainmakers and deal makers in the sector to help you fast-track your career and achieve long-term success. My name is Robert Bezede, and I started my career in the commercial banking sector. Today, I'm a middle market M&A advisor helping Canadian companies sell. Thank you for listening to this podcast, and be sure to check out my YouTube channel, Finance Kid, for more content on commercial banking and M&A related topics. So let's jump into today's episode. Dave, thank you for making the time. How are you?
Not too bad, Rob. I'm happy to be on your podcast here.
Amazing. I appreciate you making the time. So I really wanted to have you on here because ABL is a sector that I would still consider more of a niche subsector of commercial banking. And so oftentimes people don't really understand where ABL fits in the marketplace. How does it work and what are the career opportunities there? You've really built a great career for yourself. You're one of the 4 directors leading TD's ABL group now. So you're in a great spot to really share your experience and journey to where you got to today. So let's just jump into it and just talk about your current role today at TD. What do you do? What does an average day look like for you? And talk about the clients that you're typically working with.
Sure. Not to jump into the whole ABL 101, but it is, to hit on your comment earlier, it definitely is niche-y, not fully adopted in Canada, and we can dive into that later. Clients we deal with, it's working capital intensive businesses that sometimes have thinner margins and need some sort of financing outside of conventional parameters that allow them to access capital, and more specifically, senior debt capital. Day to day, it changes. It changes on a dime. We kind of flirt with principles of going concern. Companies aren't always the healthiest. And on the flip side, sometimes they're robust with liquidity and they're the easier ones, but I'm not sure if that answers the question.
So really, in terms of your day-to-day, it sounds like you're also doing the origination, you're managing the credits. How big is the team today in Canada for TD?
We're a team of about 30 credit professionals, and it's not all underwriting. It's not all portfolio management. We have a big collateral team that really hones in on monitoring, I'd say, trends in collateral, how quickly inventory flips to AR, and generally us, which is going to be consistent with our peers or any other respected ABL lender, is being laser focused on liquidity and preserving those kind of going concern principles.
So let's take a step back. How would you describe ABL in a nutshell, and how does it fit in the marketplace relative to other subsectors of commercial banking?
Sure. ABL, the acronym stands for asset-based lending. And it's funny, Robert, the amount of inbounds I get thinking that we do mortgages is astronomical because the name doesn't really lend itself to what we actually do. But asset-based lending is a working capital product that helps companies better leverage their underlying working capital defined by accounts receivable and inventory to maximize their access to liquidity. Um, I think maximizing access to liquidity is probably an important thing to hone in on, because it leads, or it's a good way of trying to chop up where we play in the market. When you need to maximize access to liquidity is either deep turnaround or early stage turnaround, or turnaround in general, or some type of hyper growth situation.
Yeah. And then in terms of size, what would be the average loan size?
I'd say on a funded basis, 10 million bucks on the low end.
Okay.
And
And
frankly, if I like a deal for 10, I like it for 100. The underlying fundamentals don't shift dramatically. There might be industry concentration in furniture distributors, and someone might decide, hey, let's ease off here, or let's be more selective. But that stuff's out of my control. But generally, again, if I like it for 10, I like it for 100, absent these.
fair enough. And then what about sector? Do you find that there's more common sectors that use ABL relative to the other sectors that don't traditionally have ABL products?
Absolutely. I think to properly answer that question, we got to look at why the reasons a company would come to ABL and compare ABL to conventional. And
Hmm.
so, if it's okay with you, I'd love to unpack that a little bit, and
Yeah.
it can
Yeah.
hone in a bit on where ABL works, where ABL wins. Traditional commercial conventional lending focuses on normalizing some sort of EBITDA, some sort of cash flow, some sort of leverageable cash, and applying a multiple on it. Irrespective of industry, pick your number. 5 million bucks of EBITDA at 4 times gives you a $20 million loan, irrespective of industry.
Yeah. And you're talking about the leverage multiple. So
The
on
lever,
average, most middle market bankers would land anywhere from 2 to 4 times your EBITDA benchmark. Yeah.
bingo. So where does ABL win? Where does ABL prove some sort of utility? It's when EBITDA might be thin as a
Hmm.
percentage. You're not generating a ton of cash. You're generating enough to earn a healthy profit, to earn economic profit, but you need a bit more debt because you're working capital intensive. So what does that mean? In my experience, distribution businesses, industrials, manufacturing, food and bev to some degree, but generally businesses that are high revenue. And I say revenue because it's a great leading indicator of the receivable base, and low profit margin. That's where we win because we can fund or size our loan as a function of the working capital as opposed to a multiple of underlying cash flow. So
So
perhaps an ABL loan might, on our same example earlier, it might size up to 6, 7, 8, 9. Frankly, we have deals that are north of 20.
wow.
But they're still cash generative. It's a volume based business. They're making money, and there's a need for this type of facility.
So in a way, when I was in commercial banking, I understood ABL as an alternative to a working capital facility, right? You have a traditional banker, you have a working capital line, you margin your inventory at 50, 60% loan to value, your accounts receivable at 75. If they're insured, it goes up to 85% or 90%. Really, for businesses that are balance sheet heavy and that have equity in that balance sheet, this is an alternative to accessing more liquidity than a traditional working capital line.
Absolutely. I think you nailed it on the head. And,
Okay.
and those kind of lending parameters through ABL, we take a more microscopic approach to analyzing the AR, analyzing the inventory, bifurcating it across raw, WIP, finished goods, looking how long it takes to convert inventory in this case, convert it to an AR, collect through the AR. How robust are the secondary markets if the lights turn off tomorrow? How can we liquidate? How can we exit? So the focus on repayment is less centered around cash flow and more on the collateral.
So when you look at an opportunity, when you look at the 3 to 5 things that you zero in on when underwriting an ABL opportunity, what are those things? You touched on the first one, which is asset security and understanding the liquidity of that asset. What are the other
Mhm.
things that you zero in on?
The other things, just being frank, is this going to be a fishing exercise? Is there an ABL deal here based on the collateral? Number two, can I win against a conventional lender who might stretch? Number three ties into the first point on the collateral, but every ABL lender is going to have their quote unquote edge on what they truly think a liquidation value is. You'll have an appraisal, you'll have some third party dictating what they think in a distressed insolvency situation can be recovered, and then you'll have what you think can be recovered. And there's a lot of considerations, and I don't want to throw in jargon, but generally the idea here is to underwrite to a liquidation and say, again, if the lights turn off tomorrow, what can this company be sold for? Either as a going concern or in piecemeal. And if that number shakes out to be somewhat in excess of your loan, generally it's a green flag. It's funny, the bulk of what I do is trying to plug into to secondary markets and understanding how assets trade.
So I would assume then you have a deep network of appraisers and auction houses and liquidators where you'd be calling them when you're looking at an opportunity saying, hey, listen, I got this type of asset. What does it sell for? And you'd make maybe three or four, five calls. Is that how you do it?
Oh yeah, yeah, absolutely. And I would say I personally I go a step further. I stay very plugged in with the Canadian Insolvency Network. You can see in real time. It doesn't matter what an appraiser says. More often than not, there is some sort of disconnect between what an appraiser will say. Their interest is to give you a rock bottom value. My interest is to extend the most amount of credit to a customer. There is going to be some sort of delta to solve for, which can be corroborated by real life examples. So tying it back to the first comment, it is being plugged in with Insolvency Insider, being plugged in with the restructuring folks at various law firms, being plugged in with Ritchie Brothers, understanding what auction houses are actually trading assets for.
And so an interesting comment because I'm just putting myself in the traditional cookie cutter mid market banker role. You look at an appraisal because usually your credit team's going to ask for an appraisal, and they say we lend to OLV or we lend to CMV, the current market value, orderly liquidation value in that report. Are you suggesting that usually you guys are even going above that because typically the appraisers are building in a buffer for themselves in terms of the value of those assets?
I am definitely suggesting that, and but just to unpack that, and this isn't consistent with any ABL lender. It's a very formulaic approach to lending. OLV, orderly liquidation value, NOLV, net orderly liquidation value, which is just OLV less liquidation expenses, gives you either a percentage or a dollar amount if you're looking at fixed assets. What I think lenders in the ABL space can toggle on or be creative on is your advance rate against OLV or
Mm.
against NOLV. So depending how bullish or bearish you are on a given asset class, generally you toggle as low as 80% of NOLV up to 90%, perhaps 92 and a half, perhaps 95. Again, depending on your view and your institution's view. But there are, I'd say, levers to pull because you're absolutely right. The credit department will always look at an appraisal report and say, this is what the third party is telling us. This is what we can exit at. Okay, fine. How deep do you want to get on exit value?
Yeah. So I'm curious, this is a very classic symptom of most banks is that there's a lot of silos between the different departments. So traditional mid-market term lending versus the ABL team versus the small business banking team, corporate banking. So what's the best way to collaborate with an ABL partner, assuming this is a listener that is finding out, wow, that there's a lot of opportunity to leverage these assets in a more creative way with the ABL team. How do you collaborate internally within your bank?
I think on my end, at least, it goes back to maintaining strong dialogue with head office that has an overarching view of the whole bank, the credit side of the bank, and loans across various industries, and liaising with them to say, hey, the industrials, the manufacturing, the distribution book of business within a given bank. Let me see those names. How's their internal risk rating trending? Are they improving? Are they deteriorating? Frankly, I focus on the deterioration to say, hey, let me talk to them. It's better for the bank. It grows ABL's book of business. We preserve a client. We don't lose market share. And fundamentally, I think any bank, in my experience, and I've been at, I guess, four banks now, there's an internal risk rating, which 9 out of 10 times is very leverage sensitive. And so we'll call that probability of default, and there's a loss given default or an LGD. You multiply the two, which drives a bank to take PCL. So, in a conventional sense, if you have a deteriorating risk rating, and you don't have the benefits of improved LGD because you're in a conventional versus ABL structure, it's a natural sell internally. It works quite well. to get in front of folks and relevant opportunities to better protect the bank, provide incremental liquidity to the business, and frankly, and augment our economics because potential PCL is the probability of PCL is reduced.
Yeah. And this is a question that I've asked a lot on different interviews is for junior bankers, going through that first souring credit opportunity is nerve-wracking, right? It's always very challenging to work with underperforming files because you're worried about your reputational risk, the pressure that's put on
Oh,
you
yes.
personally. Right. So there's a lot of that. Having an internal resource on the ABL team, this is what I'm hearing from you, is a good sounding board, almost to run your underperforming files to say, hey, is this a balance sheet heavy business that you can lend against? And we can provide an alternative to take us out and shift it onto your side of the balance sheet. And instead of just going straight to the special loans department and saying, I'm waving the white flag, I don't know what to do. You're almost like a pre-step one to the step one, which is going to special loans.
Yeah, absolutely. And don't get me wrong, our intention is not to be a step one to special loans. And
Yeah.
we're and I think it's pretty consistent with all the ABL players in Canada, but generally they're more or less cradle to grave. No one wants to test the formula, but you're absolutely right. That is the sell to a customer. There's a good sell internally to transfer to ABL, but you still have to sell to the customer, to the business itself, and prove why it works. So it's the tough part, but you're right. It is 9 out of 10 times. It's a good platform to stabilize, harmonize operations, and then our goal
Yeah.
is also to launch you back into conventional.
Yeah. So that's something that even for me when I was in banking, I didn't really have that. I call it the playbook. You're almost like an NFL coach and you got all your different plays that you got to run based on the words that come out of the client's mouth, whether it's a succession planning or tax or underperformance discussion. Now what I'm trying to do with this podcast is really show that there's all these other sub players within the economy of commercial banking that a true banker's banker needs to have those relationships to say, oh, this is something that I should steer towards the ABL team, or this is something I should steer towards an alternative credit provider. So this is a really helpful overview of that. And so pulling on that string, really when it comes to underperforming or souring credit opportunities, how do you decide when it's too far gone? There's that whole, is there still a pulse and we're going to work with that company and really provide an alternative versus this is something that we have to send towards an alternative credit provider? How do you decipher between those two?
It's a tough one, and I don't think there's any specific playbook per se. It is very much a touch and feel exercise. What I would say, and I know this is loose, but you really want to preserve going concern principles. And it's not a buzzword, it's something I'm intentionally saying. You need to make sure that the business is not insolvent. You can flirt with insolvency, but don't be insolvent because even your liquidation values are contingent on some degree of marketability of the underlying asset or the whole business. Anytime you exit a file, your best exit is selling the business as a whole, as a going concern. And
That's
every
right.
business trades different. And this, Rob, like it's not always a multiple of EBITDA. Sometimes it's this quasi fair market value of assets plus goodwill. It's a bit of lick your index finger, throw it in the wind. And what does a business trade for? But preserve that. How do you preserve that? Part of it is marketing. Listen, if you want to get refinanced out of a transaction, you need to show that the business has liquidity. You need to
Mhm.
show it has liquidity because it prevents anyone thinking that the business is insolvent. So how do you preserve liquidity? Maybe for a period of 6 months, you leverage up some machinery and equipment that might be more bespoke in nature and nailed into the ground. But any other bank, we'd be happy to take you out.
That's right.
It's a difficult question to answer.
So I would compare it to traditional lending, where in traditional lending, you're so focused on driving the car, looking in the rearview mirror and saying, this is what the company did in the last 2 years. So we're going to underwrite on a debt service coverage ratio. And so
Sure.
long as the cash flow covers our term loan and the obligations, we're fine.
Mhm.
In your situation, you're almost looking more forward looking. You're that in between a traditional lender and an equity investor where you're looking at the history, but you're also looking at what the next year is going to unfold like, what the security looks like, and also your takeout. I think there's
Mhm.
a higher emphasis, correct me if I'm wrong, in the ABL space on what's your exit plan versus in the traditional term loan world. So long as this historically continues the way it has, we're just going to get paid out in the next 5 to 7 years and we don't need to worry about takeout.
Oh, you're absolutely right. Let me say this too, because I'm quite proud, but I have never put on a deal that has resulted in a loss.
Wow.
So
Good.
there is quite a bit. There's been restructurings and there's been a bit of a Mexican standoff, if you will,
Yeah.
to force equity, to have some tough conversations. That those inevitably happen. But really, if you truly underwrote a good ABL, you should exit clean, whether it's through liquidation or sale to a strategic. If you have the benefit of working in a bank, you can pick up the phone, call the investment bank and say, "Hey, listen, do you have any sponsors that are looking to buy a distressed asset?"
That's right.
The devil's in the details, of course. It's look at the credit agreement, what are your assignment clauses, can how
Yeah.
cleanly can you exit? But generally speaking, 9 out of 10 times, if you test the formula, you should exit clean, provided you're toggling back your advance rates through the process and holding a bit of a torch under the company's butt.
So I'm curious. Obviously, in your role, the conversation is a little bit more tense, right? You get into these situations where you have to put in equity, or you have to be a little bit more not combative, but more proactive with the client. So for people that are coming up in the ABL business, and there's this whole question of imposter syndrome, being a younger banker and sitting in front of a client that's twice your age, and challenging them. What advice do you have for bankers in terms of how to manage those tough conversations and tips and best practices in that area?
It's one thing to know the numbers, and I'll be the first to admit it. 9 out of 10 times, your sole proprietor knows their business 20 times, 30 times better than you do. You get a couple reports, you read it. In my case, you have a better understanding of the liquidability of the collateral, but they know the operations, they know what entities invoice. It's difficult. And I think that it goes back to a larger conversation around even selling credit, but
Hmm.
you have to be able to read a room, read facial expressions. No one says anything without purpose. Any comment, any sentence, any word chosen that's delivered to you audibly is said with purpose. Understand what that purpose is, understand where they're coming from, and understand how to tailor your comments accordingly. People won't like what you have to say, but if you communicate it and massage it in a appropriate way, they will also understand. At the end of the day, any business has investors, whether you're on the debt side or the equity side. In the case of a bank or any lender, you're on the debt side. You want to make it collaborative. And you made the comment earlier, reputational risk, that's always a big concern. No one wants to put people out of jobs. The Canadian economy is so intertwined. Pension funds owning real, it's no one wants to do that. So you want to gently guide, whether it's a sponsor, a sole proprietor, into the right decision where there's some sort of risk sharing. The fine line, the line in the sand you have to draw is at what point is this debt risk and at what point is this equity risk, and sufficiently communicate that.
And really, in terms of some of the mistakes that younger bankers make in the role, what have you seen from your past experiences or others in the sector?
It's, I find with, and you know what, I fall into this bucket too, but
Hmm.
truly, I think I got into the general lending in 2012. I've never really seen a true recession. Now, knock on wood, I'm hoping it's here because I've been waiting for a recession my whole career, but I've never truly experienced a recession. And the folks younger than me have not either. It's consistently been a bull market. So I think it'd be naive to always think that, or to look through the world through rosy glasses. You gotta understand that things can go wrong. That's what the mistake junior bankers make, or sometimes I'm guilty of it too, is the world can crash. I think I got a good hand on the pulse of the economy, but it can crash. If it does crash, how do you mitigate? Because at the end of the day, it's at least the way I was trained, but working for a US bank versus Canadian bank, I found that the best training, the best advice I got was, are you personally willing to cut a check to lend into this business? And if the answer is yes, lend away. Now, if the answer is yes, you better, again, I take that to heart, but well, what are my mitigants? What, and don't get me wrong, you can't mitigate everything. Where any lenders in the business of pricing risk. What risk are you comfortable and what's the price of that to you?
Yeah. This is the reason why I had you on the podcast, because I really appreciate your view of the world, because it really aligns with the way I think as well. And I'm a big believer that some of the best long-term investors have a part of themselves that are true pessimists. They're always afraid of the world falling around them, falling apart
Yeah.
around them. And the reality is, the moment you get a little too hot, and especially when the rising tide lifts all boats and bonuses are high, everyone's just closing deals, you're worried about doing the most volume. That's when really the biggest mistakes occur. And it's always having that kind of the back of the mind, the voice inside of you to say, but what happens if things don't go as planned?
Yeah.
Okay, so we've been alluding to this because we almost flipped this a little bit on its head, but I'd love to actually go back to the start of your career because you worked with 4 different banks and you've actually had the opportunity to not only work for Canadian bank, but also a US owned bank in Canada. So maybe let's go straight to the start. How did you get into commercial banking?
Sure. Might not be the popular answer, but so my first job was at Scotia in the corporate bank.
Okay.
Why I took it was that at that time I had a mentor who shared some biases, but essentially, and just being honest, it was a function of compensation relative to work hours. And when you work in the corporate bank, that's you reach that harmony.
Yeah.
I'll tell you, I quickly disliked it. I personally, I found corporate banking a bit boring. You didn't really, you never really extended credit to make money. You were not looking to make money for the bank, for the institution, for your stakeholders on a loan only basis. It was always a wedge in, a loss leading product for the purposes of ancillary, whether it's a high yield, some sort of equity raise, a tack on. But you never really controlled the relationship. It was boring credit, and irrespective of the fundamentals of analyzing a business, there was always a larger economic discussion at play that would dictate a yes or no decision. I knew I wanted to be, I liked transactions. I liked kind of general deal flow for whatever that I didn't know a whole lot except what I read in the news, but felt like I wanted to be a part of that. And then even then you got to decide, do you play on the debt side or the equity side? Again, being frank, the equity side is hyper competitive. The debt side was easier to understand. I had the privilege. My father was an accountant. My mom was a lawyer. So general, I wouldn't say security law, but the legalese that is more relevant to credit was always a discussion table at dinner. So it felt like a natural alignment. So, anyways, went to corporate banking at Scotia, got real bored real quick. But I will say it teaches a lot about the regulatory environment, about extending credit. Because when you're a junior, that's what you're doing. You're writing annual reviews, you're monitoring compliance, you're tracking trends, you're dealing with general loan portfolio management or high risk files or high risk committee. You're interfacing with them quite a bit to understand an overarching view of the credit book. In this case, it was of the corporate credit book,
Mm-hmm.
where the stress is, where the fault is. So you learn a lot, but it was boring. Switched to RBC in a similar function. And then a good friend of mine, actually from business school, he was working in ABL and he reached out and said, "Hey, it's super interesting." So I took him up on it, had coffee with his boss, learned a bit more about ABL, and more importantly, the banks, why they even had an ABL book.
Mm-hmm.
And the answer there, at least the one that resonated with me, is we're looking to make money on a loan only basis.
Yeah.
And on a risk weighted basis, you can actually make good economics and drive value for the bank. So that was check mark number one. And then number two, it's hey, debt's an important part of the Canadian economy. Businesses don't grow without debt. Businesses
That's right.
don't recover without debt. Transactions don't happen without debt. The bulk of transactions happen predominantly funded by debt.
Yeah.
So it's just generally an interesting space to play with.
I'm curious, transitioning from corporate banking to ABL, what was the biggest mental shift or learning hurdle for you transitioning between the two groups?
Quality of information. When you're dealing with large, sophisticated, investment grade rated corporates, boy, the information is fantastic. You can lean on Moody's, on S&P. For the bankers out there, you log into Cap IQ, you plug in the ticker. You don't have to do a ton of modeling. It's all pretty much plug and play. When you get into a business with 75 million plus of revenue, sub 800 million, the information's not the greatest. You have to scrub it. Like you're pulling sub ledgers, you're looking at inventory reports, you're looking at org charts, you're trying to figure out what entity invoices, where collections take place. You're looking at bank accounts. You're really in the trenches. It's a completely different animal,
Yeah.
and it takes a lot. It takes a lot to get. Actually, I would say it takes more legwork to get a $20 million loan done than a $2 billion syndicated loan. I think that was the biggest difference. It was you think the world.
Yeah.
I worked corporate banking. I worked on the BNS investment bank because that's where it all falls under. But you
Yeah.
think you work on these big platforms and you're so sophisticated. Oh boy, when you really take a peek under the hood of these smaller businesses, you learn a ton, but you also can appreciate the operational efficiencies or inefficiencies that exist within the business.
That's, I think, the beauty of what we do. Like, we're both in love with the middle market. I never want to leave. The characters and the owners of these companies, really, you're dealing with very unique individuals that are making a lot of money for a single family. And so they all have these very unique personalities. The numbers aren't right sometimes, and you have to really be a little bit more of an accountant and get into it and really peel back the layers of the onion to understand the core story. And that's what makes it so exciting, because every deal is different. It's easier to do the larger ones than the smaller ones. The smaller and smaller you go, the less sophisticated they are, the less the correct the information is, and the more actual scrubbing and legwork is involved. So you need to
Totally.
really be honest with yourself in terms of your career. Do you really love the process and getting into the details, or do you go up market more for the convenience of having that very clean, steady information flow? So,
Yeah,
yeah.
absolutely.
Okay, so your buddy brought you over to RBC ABL, and you spent a couple years there, and then you made the switch.
The next step was to PNC, which was a US bank operating out of Canada. I think PNC in the States is a very built out, intentionally targeted middle market ABL platform. And for the listeners, you can even search PNC Business Credit. It was more than ABL, it was recurring revenue loans, it was unit tranches, it was sophisticated credit. And that's what enticed me to join. There was an opening, and it's funny how the market works. This is how I got into the role. There was a deal that RBC agented, which I was the associate on. And so you get to know everyone in the syndicate and in the lender stack. And then someone in the lender stack from PNC reached out and said, "Hey, we got an opening. You want to come in and have a coffee?" And that's how the conversation starts. So I was enticed by it felt like an uphill battle, which again, like to be in the trenches, like to learn a bit more. And I started in portfolio management, moved to origination, but a mentor, the same mentor of mine, told me you'll learn a lot more at a US bank than you will a Canadian bank, which I took for face value. And I placed a lot of weight on it and I decided to take the jump. I mean, it was awesome. I don't regret it
Yeah.
at all. Yeah.
And was it true, the advice that your mentor gave? Did you find that the training or the resources available to you, even being in the satellite Canadian operations, was better? Or what was your take on that experience?
It was tough at times because there's a kind of fundamental disconnect between the Canadian lending atmosphere and the US. So all the same, the oligopoly in Canada, 2 to 4 times cash flow leverage. That 2 times as a floor exists in the States. 3 times you're calling sub debt for maybe a half turn of leverage. You might be calling mezz. 4 times, again, cash flow leverage. I wouldn't say it's a stretch, but it's more one off than normal. So it was oftentimes very difficult to bridge what the value prop was of the bank, the US bank here in Canada. Did I learn a ton? Yes, absolutely. The credit culture at times made it difficult to win. We won more on some of those bespoke products, the recurring revenues, the unis, the stuff that was maybe a bit more exotic for the Canadian banks. But the pure play ABLs, it was, if you think about a bell curve, and on a normally distributed basis, you got your two tail ends. On the far right, you got hyper flush with liquidity. Those ones, you never win. It's a beauty contest. It was more on the far left, that 5% where it's that middle ground is a bit more uncertain. That's where we won and where we could probably implement some thoughtful structuring. The focus was more on it was very much a sponsor centric approach. Acquisition financing, get plugged in. Fund A raises 700 million. They like distribution businesses, stay in front of them. That's fine. We
Yeah.
can put an ABL in place for 5 times, but a marquee Canadian sponsor is going to and this was very important too, was just the regulatory landscape in the Canadian market. Canadian banks are allowed to be LPs in in a GP or a private equity fund. The US, that's not allowed. So
Hmm.
how are you going to bat with a marquee Canadian sponsor where you have maybe two of the five banks as LPs
Yeah.
that by virtue of investing in their fund, they get first looks at credit and will probably stretch to six times, that erodes the competitive dynamic or the competitive advantage of an ABL. So it was you learn a lot. You learn how to be creative because that's your ultimately your competition. You're in here to
Yeah.
win. So how can you
Yeah.
be a bit more thoughtful while still appeasing credit? And I think that was huge learning for me.
Yeah. So you spent a couple years at PNC. Why did you leave and why did you choose to go to TD afterwards?
I left. Really, it was the opportunity to join TD. Not to say I didn't have a fantastic boss at PNC, but had a bit of dialogue. The head of the group reached out. We had some meaningful conversations, and it felt exciting. And I guess, frankly, the sponsor centric approach, it's overplayed. Everyone under the sun is doing it. There was no longer a competitive advantage. There was nothing I felt like I could personally sell. And so I got the call and decided to hop over to TD.
Nice. And so, but you came over to TD and they really wanted to put more resources into the division to build it out. What was that experience like transitioning to TD in terms of building out that book of business? Like, how did you go about building that business coming from PNC and then previously RBC?
It felt like a bit of a plug and play. I think once you move into origination and you develop a name and know the relevant players, it's nice in the sense because that Rolodex belongs to you.
Yes.
Um, it's your Rolodex. It's on you to learn ultimately who's got the keys to the balance sheet, learn what they like, what they don't like, and learn how to message it appropriately. So I wouldn't say it was a difficult switch at all. It felt quite natural. And it was nice because that same Rolodex, I've had the same personal number since 2006. So people still buzz my phone. The bulk of my day, frankly, is on the phone. So the phone's still buzzing. It was obviously when you join a new institution, you're getting out for lunches, bringing in your internal stakeholders, getting everyone cozy, but nothing really changed.
So that's a perfect segue into the discussion of building out your book of business and those relationships. For junior bankers, oftentimes you went through that journey as well with ABL. You started more on the annual review and doing the underwriting and doing the portfolio maintenance side. And then slowly your boss said, okay, now it's time to go actually out and start developing business. For those younger bankers that are just approaching that inflection point in their career, what advice do you have for them? How did you go out and build those relationships?
I think generally, and if you read the news, there's a flurry of, especially now, or at least in the last 18 months, there's a flurry of private credit funds. Private credit has a resurgence. There's lots of banks, there's lots of lenders, there's lots of equipment finance lenders. What I'm trying to drive at is everyone has a balance sheet that needs to be deployed. How do you differentiate yourself? How do you make sure? And you don't have to be the first call. You can get into a beauty contest too, but you want to be called. How do you get called? Selling credit is not selling a balance sheet, it's selling a relationship. And it doesn't mean, hey, Jim John, let's go grab a beer, let's grab dinner and have meaningless conversation. You don't want that either. Believe me, the person sitting across from you, they might not want to spend their Thursday night with you, but you want to
Yeah.
make sure they do. How do you do that? You got to give some value add. You got to talk frankly about what you're seeing. You got to connect the triangles. You got to weave together what's going on, what you're seeing. You got to marry up your institution and your institution's appetite with what's going on in the market. Talk about tombstones, talk about transactions you've done, talk about stuff that you're innovative on, be transparent. If your institution is more sensitive to food and bev because of some over concentration, communicate that too. But you got to provide some value add. Um, and you got to tailor your comments. When I talk to you, Robert, you're all over the street. I want to give you all the intel I can about what's new and sexy in ABL, what we're looking at, how valuation has changed. When I talk to the owner of a manufacturing business, to the extent my bank's not an incumbent, I want to talk about, hey, listen, I know you don't want to switch. Maybe you're happy, but why don't you send me your credit agreement and let me give you a sanity check? Let me make sure it's on market.
Yeah.
And at worst case, you keep your competition honest. So that's the value add because it's not all going to Raptors games or Leaf games or, again,
Yeah.
having beers or having lunch. You have to provide tangible value.
So I love that you said that because that's why I love our conversations. You're really authentic when it comes to the way you communicate. You present yourself as someone that knows your product and knows your space very well, exactly where you play. And you can do a good job of communicating that to the user of that product to say, hey, I may not be for you right now, but this is what I do. And here, this is what I'm seeing. And so when you first were starting, was it reaching out and setting up coffees? Was it going to certain events? What were the key COIs that you were focusing on to build up your network in the early days?
Probably consistent, but it started with the big four. And then you quickly realize their goal is probably to get as many term sheets as possible. So you learn that pretty quick, but go through the hoops and hurdles, make those relationships, look at as many sims as possible. And right now, these comments are just on the acquisition financing side. Sometimes it's a refi, but 9 out of 10 times it's distress. A healthy company doesn't hire a debt advisor. They're well banked, they're well covered. Get your reps in, take looks, and massage it internally with your stakeholders. Get a feel of their sentiment, which will allow you to extrapolate. Okay, here's what I'm sensitive to. Here's what the bank is sensitive to. You can figure out, oh, we're not sensitive to this, but the feedback I got was that other banks were. Lean into that. I find SFNet, for me personally, a great resource, a great community. Same thing with ACG, same thing with TMA. Earlier on, I was on the Mississauga Chamber of Commerce. That was also intentional, large industrial presence.
Yep.
But get out there, wave the flag, meet as many people as you can, have
Yeah.
the coffees. And I know this sounds so boilerplate and it's not my style, but
Yeah.
frankly, before you get married or before you settle down, have kids, that's the time. Spend it on planes, trains, buses, get around the city, meet as many people as possible,
Yeah.
spend all the calories, have the coffees. You learn a ton.
Yeah, it is an apprenticeship type business, right? So the
Oh,
only
yeah.
way you're going to
Great word.
learn is that you have to keep doing it every single time. The reps really matter. And I remember being on the road and there's a whole discussion around deal fatigue and sales fatigue. And I remember there were times where all my social battery was completely drained. And I was like,
Mhm.
how am I going to go to these 5 meetings that I've booked on a Friday?
Oh, yeah.
Like a
Yeah.
psychopath. But you do it because the reality is those small incremental conversations. Look at our conversation. We connected back in your PNC days. And
Right.
when we were, and I think I was at Roynat at that time, and I was thinking of different ways to pick up some of your smaller deals that were coming across your desk. That was my angle at the time. And look at now, I'm in the M&A business, and you're in a different bank. But the reality is, all these different connections that you're making, you build this garden that will hopefully bear fruit for your future years as well. So what you're saying is exactly right. It doesn't have to be sexy because it's not, right? At the end of the day, it's just putting in the work and doing the reps. So
Yeah. Yeah. And that's so funny. Even when you were at Roynat, it's the same thing we're talking about here. Knowing your angle and playing it. That's the
that's
value
right.
add. And go hit it up. So if it's smaller deals, if it's restructuring, if it's M&E heavy deals is what you're bullish on or what your balance sheet wants to deploy against, well, go
Yeah,
chase it. Find those people and have the coffees. Because you
that's right.
never know, you'll get the calls.
Especially in your early days when you have the time, because later on you have to be a little bit more efficient with your network. But you're right. Like in my early days, I was just a machine. My boss told me, you have this corporate credit card, use it. You're
Yeah.
paid to go and use it. Go and
Yeah,
have those conversations and lunches and coffees. And because you'll never know where these relationships will lead, like our relationship here. So that's a great summary of the way you've approached your business. I appreciate that.
for sure.
Uh, so just quickly on keeping your skills sharp. How do you stay up to date in terms of resources, podcasts, books that you're reading? Is there any recommendations that you have for younger bankers?
Starting with the last one on books, I find I spend so much time reading credit agreements. I find it very difficult to actually sit down and read. Keeping the skills sharp for me personally in the ABL space, and I think it marries up with a lot of the earlier comments we made, but stay in touch with your insolvency partners because it's worth knowing the leading indicators of when things will go sideways. That's frankly, and it's probably where I spend the most time is trying to read up on precedents on insolvency law. What does that mean? I go to PwC and like the monitor report. You have kind of publicly available documents. The one I'm reading up on right now is Victoria Gold with PwC. It's interesting. It's a mine. There's stakeholders with Indigenous people. There's equity at play. I find the insolvency space generally interesting when it comes to the debt side of the equation, what the Rolls-Royce standard is on a security package, where the faults are. And I find that keeps me sharp.
Yeah.
Talking about having lunches. I don't really shop the deals I do get. I don't really shop them out to a bunch of firms. I got 3 in the pocket that I keep close to. I know how to work with them. Given the deal, I'll send it accordingly. But I have active dialogue with the 3 firms. And also plug in with their insolvency teams. I find it's value add for me. For them, I think it keeps me sharp.
And I love that you touched on the case studies because that's the best way. Funny enough, when I was at Roynat, I was on insolvencyinsider.ca.
Oh, big shout out. Everyone get on Insolvency Insider.
Seriously, right?
It's
like
awesome.
I was on that website and I loved it because thankfully, once you're going through the restructuring side, it comes into the public realm and there's really detailed proceedings of how things unfolded and all the relationships with the different stakeholders. So even for general commercial bankers, I think it's an area where that you don't have a lot of visibility on these smaller middle market deals because they're all private. But in the insolvency side, you actually have a lot more visibility on how that deal was placed and what went sideways and what is happening now. I'm happy that you mentioned the PwC monitoring reports as well, Insolvency Insider, and all these other resources where you can just publicly just keep track of files. I think that's a good way to stay top of mind.
Deloitte, KPMG, A&M, EY. M&P, everyone has it. Tons and tons of good information. It's like just read the sequence of events, right? It's interesting.
So, Dave, you've been awesome. I really appreciate your time here. So, last question. So, I'm curious, you've seen a lot of transactions across your career so far. What's really that top company sector that you've lent to? What's something really interesting that you can share with the listeners?
I would say being a Collateral person, it's a public company, so I'll spare some details, but you would not believe that an ABL that focuses on liquidating goods within 90 to 180 days could lend into a perishable sector, specifically kind of wine and spirits. But you would not believe that, or what I learned along the way was that grapevines have a ton of value. Because if you think about it, for purposes of harvesting wine, you might plant a vine in year 1. You can harvest grapes in year 3, but grapes trade at whatever, $2.99 per pound at retail, which means wholesale is 99 cents a pound. But once they get to year 10 and they're in maturation and can produce good quality vine, it skyrockets, number 1. And number 2, the insured cost is tremendous. Something I found incredibly interesting, something I found unique to lend against, but very explainable.
Wow. That's why I asked these questions because I would never have thought that. Wow.
Here's a question, Rob. Do you call that grapevine a raw material, a whip, or a finished equipment? Or equipment? Yeah.
Because it's yielding you the actual finished good. Oh, interesting. Well, I guess there's no way you could capitalize a grapevine. That'd be crazy. I think the CRA would be all over you. So I'm curious, did you guys look at it as a raw material, as a finished good, or how did you guys approach that credit?
I think it was a challenging credit, and we looked at it as a meaningful amount of boot collateral. But for purposes of extending credit and approvals and documentation, there was enough other assets to get the deal done, but that was kind of sweetener on top.
Very cool. Dave, that's a perfect end to our conversation because that goes to show you just the different types of companies that you come across in the ABL world. As I mentioned, it's a bit of a wild west and you're coming across more creative situations that wouldn't fit the traditional commercial bank in the term lending side. And I think that's why I wanted to do this podcast is a lot of younger bankers and students thinking about their career. ABL is probably not top of mind. It's
For sure.
very
Yeah. Yeah.
undercovered, but it's an incredible opportunity to really come across some pretty exciting deals and also be, as you said, a little bit more creative. And I really like the way you position corporate banking versus ABL, not really focused on just being a provider to a broader relationship for the bank, but actually being the bank's source of profit. And
Mhm.
actually, your decisions directly influence the amount of profit that's generated in that group. So that's really interesting.
Absolutely.
Listen, Dave, I appreciate your time. Thank you for making the time. Thank you for listening to the Inside Commercial Banking podcast. I love creating this content, and I hope that you found it helpful. Now, can I ask you to do one quick favor? It would help if you could share this episode with your colleagues and like and subscribe to the podcast. The more exposure we can get on social media, the more guests we can attract. I hope this podcast can be the go-to resource for aspiring commercial bankers and middle market professionals looking to learn and grow. So be sure to also check out the Finance Kid YouTube channel for more content on commercial banking and M&A in the middle market. Now, lastly, if you are based in Canada and you have a client that is interested in buying and or selling companies, I would love to connect with them. Please reach out to me over LinkedIn, and I'm more than happy to have a conversation. Thank you for listening to the podcast, and have a wonderful day.